Hi, I'm Patu from freefincal, and after the DHFL crisis or the SLZ Entertainment bonds problem a few months ago that hit the fixed maturity plans and debt mutual funds, the question on everybody's lips is there a way to avoid credit problems or credit risk in mutual funds? Can I invest in such a way to lower my risk? Sadly, there was, but unfortunately, after the SEBI categorization rules, and this is ironic, after the SEBI categorization rules, things have become from dicey to actually worse. Um, so in this video, I'm going to run you through the available categories of debt mutual funds and some hybrid mutual funds. I'm going to explain why you cannot escape credit problems in mutual funds. So if you want to know if I can avoid debt mutual funds altogether, yes, there are options. If you want to avoid debt mutual funds altogether, there are options, which is well known to everybody. So the first thing I want to show you is this is the SEBI categorization circular, the first circular that came in October 2017. They followed it up with an addendum in December 2017, and the idea in this circular was to bin mutual funds into nice, clear categories, making it making each category have a distinct investment strategy, asset allocation, etc., and making it easier for the investor. Unfortunately, I was enthusiastic when it came out, but unfortunately, things have become more complicated. It has now become more difficult because the overlap among the categories has actually increased. I would say many mutual funds were style pure. We could trust them. We could trust that they will invest in only certain types of bonds before this categorization, and actually this categorization has made the whole thing more flexible and given more freedom to fund managers, and that's always a dangerous thing. So let's quickly go through the categories. So what I've done here is I've just taken from that document that you saw, I have just taken snapshots and pasted it onto this PowerPoint. The first category is just the overnight fund. I think I have a video on this or a post on this. This invests only in bonds maturing in a day. So you give money tomorrow, you get money and something extra for giving the money. And the interest rate sensitivity is the lowest. The credit problems, the risk of the credit risk, I use the word credit risk from now on. Credit risk is very low. It is not zero, but it is extremely low, and also the risk is it's hedged with the collateral and so on. The price you pay for that is the returns will be lower. It will be a touch higher than a normal SB account, but lower than a fixed deposit. Liquid funds, we all know, can invest in bonds that mature within 91 days. We have seen cases where, because of the interest rate, sudden jump in interest rate, the NAV has dropped a little bit. We have also seen credit problems, I think last year because of the Island FS, if I remember, September 2018, if I remember. So they are not free of these. So be careful. Do not chase after liquid funds which invest in risky paper and with a high yield to maturity. That means you definitely will have a credit problem. Stick to a fund like Quantum Liquid, which explicitly says I will not chase after credit risk. Stick to that kind of fund. Don't ask me what about Parak Parik Liquid Fund. Parak Parik Liquid Fund so far has been good. In principle, it can invest in corporate bonds, although it is much of its portfolio has been in gilts. So in principle, it can invest in corporate bonds, but Quantum Liquid will not even do that. So I would say that's a little better because it has explicitly mentioned that. I would trust that better. See, don't chase after returns in liquid funds and overnight funds. In ultra short term, this again will invest in bonds that mature in a few months, 3 to 6 months. There is an idea in mutual funds called duration. I have a post explaining what duration is. I would love to make a video on this, but the problem is people will not watch it. They want returns. They don't want knowledge. They just want fund names, and they want everything, just the reward without the effort. And I mean, 1,000 people will watch a video where I say top funds, 10 people will watch a video about duration. That's the problem. So it's painful. But if you're interested, I will be happy to make a video on duration. But anyway, you can read this post. So the Macaulay duration, and there's another idea called the modified duration. These are all measures of how the bond price will fluctuate depending on the duration of the bond. Depending on the supply and demand in the market, how much the bond price can fluctuate depending on the tenure of the bond. So that's a very, very simplistic way of looking at it, with more technical descriptions available there. You have to look at it in terms of yield and so on. I don't want to get into that. So this can take on the huge spread in the kind of funds here, very risky funds. Finding a safe fund is hard in this category. That's my problem. I mean, today if I look at the portfolio, their funds will all be A1 plus kind of bonds and so on. But I don't have any guarantee that they will remain the same. That is the problem. I do have recommendations in my handpicked list of mutual funds, but please be careful. There are risks everywhere. So that's my point. You cannot avoid that risk. So low duration funds is between under a year, 6 to 12 months. Again, you cannot avoid credit risk. More riskier. See, one thing you should understand. If you keep looking at this Macaulay duration, the higher the Macaulay duration, the higher will be the sensitivity to interest rate movements, and very important, the longer it will take for a fund to recover from a credit issue. So if the fund NAV drops like that, it will take that much more longer depending on how the kind of bonds that they buy. Of course, if there are certain situations where they can get back the money and so on, but I'm talking about pure default. Or there can be there can also be a situation where the fund goes from AAA to AA. That will also reduce the NAV. Please remember. So recovery will take longer depending on the duration of the bonds. Money market. Many people have a mistaken notion that money market funds are safe. Not at all true. The new category earlier in the olden style of investing, money market meant liquid kind of funds like a few months investment and so on. But in the new category, money market is a very fudged up category where they can invest up to 1 year, and there is a lot of credit risk in that period. So be careful in this area. Short duration is 1 to 3 years. Again, and please keep in mind one important axiom. If the Macaulay duration is 1 to 3 years, this means your investment tenure should be at least 3 times this. Do not invest for 1 to 3 years. That is just stupid advice that's written in textbooks. They will say max the duration of the average duration of the debt fund to your investment horizon. There's no bigger bullshit than that. If the fund can, for example, if you go back to money market, if that is 1 year, invest in this kind of funds for at least 3 years. If this is 1 to 3 years, 3 years means invest in it for 7, 8, 9 years. That's the kind of thumb rule you should have. The reason I am saying is, if there is a problem, the NAV will take a long time to recover, and before it recovers, the deadline for when you need the money will come. So be very, 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 very careful. Medium duration is between 3 and 4 years. There was an addendum issued in December 2017. They changed it. They said that if the fund manager wishes, they can reduce the duration of the bond. So there's some kind of dynamic bond nature in the medium duration funds. Please be careful. I keep saying again and again, things have gotten worse after the SEBI categorization. Because of this, funds can behave like other funds now. So again, no escape from credit risk. Medium to long duration, 4 to 7 year kind of duration bonds. Again, it has become 1 to 7 years. They added that addendum and said, if there are problems in the market, the fund manager can go to short-term bonds in the interest of investors and so on. But again, it can behave like a dynamic bond fund. So please be careful. Again, no escape from credit risk. And if you have a credit risk in this problem, if there is a downgrade in rating, the NAV will fall and take a long time to recover. Please do not invest in such things for short term. Long duration fund is greater than 7 years. Typically greater than 7 years, you will find many the gilt funds in this category. Dynamic bond, it can invest across duration. See, if what is the difference between dynamic bond and the medium duration bond? They can also invest between 1 to 7 years. That is also investing across duration. So do not invest in dynamic bonds unless you are aware that they have both interest rate problems as well as credit risk problems. They will invest in long-term bonds, then there will be interest rate risk as well as credit risk. They can invest in short-term bonds, then there will be credit risk predominantly. So again, you cannot escape from this at all. Corporate bond funds, earlier they had said highest rated instruments. They changed it to say AA plus and above corporate rated bonds. So AA, they reduce the lowest credit rating that these funds can invest. So now corporate bonds have become more risky. Earlier it was only the highest rated. Most of them will be I mean, at least you know that they can only invest in one kind of bonds. But look at this. Now they said AA and then AA plus, they lowered it. So that's just annoying. Credit risk, they in this case they did a slightly different thing. They said minimum investments in below the highest rated investments. So they now changed it to A and below, which is a little better. At least they have made this a little less risky. But credit risk funds, unless you understand what a vertical drop in NAV is of 10%, 20%, don't get into all these funds. Please look at the AUM, look at the portfolio weights, and invest. Banking and PSU funds. See, I'll tell you here. This is the main reason why I'm making this video. They can invest in public sector undertakings. They added municipal bonds, public financial institutions, and so on. But only 80%. Rest 80% they can invest in corporate bonds. If those corporate bonds flunk, gone. So you cannot escape credit risk by choosing banking and PSU funds. Gilt funds, again only 80%. 80% of government bonds. 20% can be in corporate bonds. If that goes, again there will be credit risk. You cannot escape it. Wherever you go, you can run, but you cannot hide. Again, this is only 80% of bonds in 10-year constant duration. I have a video. I think did I make that video? I don't know, but I wrote a post on how to user guide on how to use gilt funds. You can have a look at that. I'll link it here. Floating rate funds essentially means that what they will do is usually what happens is when the interest rate changes, the price of the bond will change in the market. Here, in a floating rate bond, the price of the bond will remain the same, but the coupon rate or the interest that they offer will fluctuate depending on the interest rate. Therefore, the interest rate risk is significantly lowered, but they need to only invest in 65% of floating rates. And they can also employ derivative, that is arbitrage opportunities like interest rate swaps and so on. But it's only 65%. Rest can be in anything else. And floating rate funds can also encounter credit problems. So you cannot escape credit risk. And then look at the hybrid funds. Hybrid funds, this is a conservative hybrid fund that can invest it must invest 10 to 25% in equity. Rest, it can be in any kind of debt. You don't know. So this can have very high credit risk problems. Balanced hybrid, 40 to 60% in debt without arbitrage. Well, still it can have significant credit issues. Aggressive hybrid, the majority is equity. So the debt is only 20 to 30%. If there is 20 to 35%, if there is a problem in the credit rating, the NAV will fall, but it will not show. The investor will not perceive it because much of the volatility is coming from the equity part. Still, you cannot escape the credit risk, credit event. Dynamic asset allocation, well, it can. This depends on the fund. Some funds prefer arbitrage, some funds prefer bonds, but still you cannot escape credit risk. Multi-asset allocation, 10% of gold, equity and bonds. What those bonds are not specified. Still, again, credit risk is possible. Arbitrage funds, this is atrocious. Only 65% needs to be in derivative or arbitrage opportunities. 35% can be in bonds. And arbitrage funds, because of the IL&FS, if you look at, I don't remember the names, I have written about it. Arbitrage funds have seen credit rating issues in the end of last year. Equity savings, and this is an minimum 10% in debt, 65% is in equity and equity related, minimum 10% in debt. So still credit risk events are possible, and we saw that day before yesterday. What is I forgot the name. We saw that, so it's quite possible. So you cannot. That's it. That's the last slide. So you just cannot escape. Wherever you go, this credit risk will come and haunt you. So don't assume you can escape it. Those are the categories. Please choose carefully. Stick to liquid funds and overnight funds if you are very worried. Then you have to sacrifice returns. Post-tax returns from that may not beat an FD. If you're worried, just forget about all this and stick to FDs. Right? So that's that. If you have any questions about all this, please leave a comment and I'll try to explain. Thank you as always for listening. If you have any ideas for making videos on this, go ahead and I will try and do them. Thank you. Bye-bye.